morning. Andrew Holland, Chief Executive Officer with Ambit Investment Advisors, joins us live. Andrew, morning. Thank you for joining us. Andrew, exactly 15 days ago, everyone was a table-thumping bear. Now, looks like everyone is a table-thumping bull.
Yeah, well, I can't say I'm a table-thumping bull at the moment. I think there's, I think a couple of things happened. One was obviously the commodity fall, which was a bright spot for India, but you can see that commodity prices are slowly kind of heading north again. So we're just ignoring that. Liquidity remains a key focus. But when I see things like the German car sales, which fell dramatically last month, and I see the China PMI data, I just get a feeling that maybe we're in for a demand shock, and that's what we saw when commodities fell so sharply, including gold. Is something that the markets are just not focusing in on. So we're coming to May, and normally it's sell in May and go away. And I think the consensus view now is that there's nothing bad going to happen out of Europe in the summer months, which we've seen over the years, and therefore that old adage won't work. But I'm betting against that. I think that there's something. There is definitely something slowing in China, and I think Germany could be the next on the cards. And I don't think markets are really factoring that in. And again, today South Korea has mentioned that North Korea could at any moment test a nuclear bomb. So I don't think that really really bodes well for the markets. So we're living on lots of liquidity. We're ignoring the bad news, but I think there's something out there which isn't going to taste very, very good in May. So I'm not a bull at the moment, that's for sure.
Well, China clearly is the big elephant in the room. Everyone knows the problem. Somehow nobody seems to be recognizing it. So, Andrew, in the light of what is happening at global level and the kind of initial round of earnings we've got, do you think markets are fully priced?
Yeah, I don't want to chase the market. I mean, I'm not overly negative, about India, but these levels I don't feel like chasing. And I think when it got to the 5,500 level, it was looking a bit more attractive. There were some beaten down companies and sectors which were worth adding to the portfolio, and that's what we did. But I at these levels, with the bank nifty up 12-13%. It's factoring in a lot of good news. It's factoring in RBI could have at least 50 basis points, and I hate to think that if that doesn't happen, what will happen with the banks going forward. So on the ground, corporates that we speak to still saying nothing's really changed. Reforms were announced last September, but really on the ground, nothing's changed for them, and they're fighting both top line and margin pressure. So even if we get an interest rate reduction, it doesn't really offset the operational gearing for India. So whilst we've all been expecting yet again that this is the last quarter of earnings downgrades or earnings bottoming, it could be the first quarter which we'll see that. So my expectations at the beginning of the year was about 15% EPS growth. I'm widening that to 10 to 15%, only because I just don't see anything moving on the ground. So that's the bad news. So I don't think the earnings potential for India is compelling enough at the moment to chase the markets at 5,800.
Andrew, hi, morning. What is your own observation of the crackdown that we've seen in crude and gold? Because historically what we've seen is it's the equities which follow the commodities after a slump.
Yeah, well, it's complicated in a couple of respects. So just stepping back a bit, when we came into the year, everyone was talking about the great rotational trade from bonds to equities. I don't think we've seen that. I think we've actually seen a move from commodities to equities, or some cash into equities. But bond yields in the US remain below 2%. So there really hasn't been any move from bonds to equities. So the difficulty is how much hedge fund money, how much of this liquidity was really propping up, oil, commodity and gold prices. And obviously we've seen some flows away from that, which is why you saw the big fall. But that would also indicate that what is the real level for these commodity prices. And if you're getting demand slowing in China and Germany, that would be the scare for me. So that's why I'm saying I think May might be a more difficult month, because I think the market's factoring that it's all okay. And I think two of the world's biggest economies are really starting to see a slowdown. I don't think anyone's saying that Germany's going to slow so much, and that would have a big impact on the rest of the European region. And I don't think that's factored into the market. So that's why I'm a little bit worried as we go into the next month and forward that there might be a demand shock, which is what was being highlighted only a few weeks ago.
And so where do you think earnings growth is going to come in from? Would it be the banking pack, given the kind of run-up that we've seen in the banking space over the last week, or rather I should say this entire futures and options series? Is it any hint of the earnings that are to come about? Today you've got HDFC Bank lined up.
Yeah, well, typically if you look at the start of the earnings season, apart from emphasis, that is, we typically get the best companies or the best results coming, and that quickly tailors off as we go into the bulk of the reporting season. So, am I looking for surprises from HDFC? Hopefully not, because that would be a disaster for the whole banking sector. I wouldn't read too much into the earnings that we've seen so far. Apart from obviously individual companies, but the earnings season is just underway, and usually you get the markets kind of feeling optimistic at the beginning, and that soon wanes off as we get through and see the results from some of the lesser well-managed companies suffering from high debt, lower volume and higher margin pressure. So I wouldn't look into these results, and I don't think I think the move into banking has really been twofold. One, the IT sector is the much